They told you it was inflation. They told you it was strong dollar policy. They told you the Fed was just doing its job. But that's not what happened. Behind closed doors in the final weeks before gold and silver collapsed, a decision was made, not by accident, not by market forces alone, a decision that had almost nothing to do with metals and everything to do with survival. Survival of a system that is running out of road. By the end of this video, you will understand exactly why they needed gold and silver down, why they cannot keep it down for long, and what happens the moment they lose control. Stay with me, because what you're about to hear changes how you look at your own money. Welcome back to Precious Metals Intelligence, the channel built for people who don't just want headlines, but who want to understand what's actually happening underneath them. If you're new here, glad to have you. If you've been here a while, thank you for trusting this channel with your time. Before we continue, it would mean a great deal if you considered subscribing, not for the sake of a number, but because this channel exists to build a community of serious, thoughtful people who care about protecting what they've worked a lifetime to build. If that sounds like you, you're exactly who this was made for. And one more thing, we'd love to know where you're watching from today. Drop your city or country in the comments below. It's always remarkable to see just how far this conversation reaches. At the start of the year, something unusual was happening in the markets. Gold was climbing. Not slowly, not quietly, but fast. It pushed past $4,000 an ounce, then kept going until it touched $5,400. For many investors, this felt like a new era. Silver was moving even faster, doing what it always does when confidence in gold grows, following behind, but with more force, more speed, more drama. To understand why this happened, one has to look at what the Federal Reserve was doing at the time. For months, the Fed had been sending a clear message to the world. Rate cuts were coming. Money was going to get cheaper again. The years of tight policy, high borrowing costs, and slow growth were said to be ending. This message mattered more than most people realized. Because gold does not move on its own. Gold moves in response to trust, or the lack of it. And when a central bank signals that it is about to make money easier to borrow and easier to print, gold listens closely. This is the part most people misunderstand. Gold is not just a shiny metal that goes up during chaos. It is a mirror. It reflects what smart money believes is coming. And in this case, what smart money believed was simple. The Fed was preparing to loosen its grip. That meant the dollar would likely weaken. That meant inflation could return. And so, investors who understood this positioned themselves early. They bought gold, they bought silver, and prices took off. For a while, this made sense to everyone watching. The story was clean. The Fed was soft, so gold was strong. Silver, always more emotional and more volatile than gold, moved even harder in the same direction. Some analysts even began speaking about gold reaching new historic highs, about a new golden age for precious metals. It felt to many like the beginning of something big. But underneath this rising confidence, something else was quietly building. Far from the gold markets, in a completely different part of the world, tensions were rising. Oil markets were reacting to conflict. And in a short period of time, the price of oil surged. It moved from around $60 a barrel to well above $100. This might seem unrelated to gold and silver, but it was not. Oil touches almost everything. It touches transportation. It touches food production. It touches the cost of packaging, shipping, and manufacturing. When oil rises sharply, it does not stay in one corner of the economy. It spreads. And that is exactly what happened. Inflation, which had been slowly falling for months, suddenly reversed direction. Just a short time earlier, inflation had dropped to levels that gave people hope. It seemed like prices were finally cooling down. But within a matter of months, that same inflation number climbed back up sharply. The story the Fed had been telling, the story of rate cuts, of easier money, of relief, no longer matched reality. This was the turning point, because a central bank cannot cut interest rates while inflation is rising. Doing so would be like pouring fuel on a fire while claiming to put it out. The Fed's promise, the one that had pushed gold and silver higher for months, quietly began to fall apart. Investors who had believed in that promise were suddenly standing on less certain ground. At this stage, most people still believed this was simply a normal market correction. Prices rise, prices fall. That is how markets work. Gold had gone up quickly, so it seemed natural that it might slow down or even pull back a little. Few people suspected that something larger was about to unfold. Few people imagined that the coming decline in gold and silver would be sharper, faster, and far more aggressive than a normal correction. But behind the scenes, the pressure was building. The Fed could no longer keep its promise of cheaper money, and that single fact was about to change everything. Not just for gold and silver, but for the entire financial narrative investors had believed in for months. What happened next would surprise almost everyone. Because what came next was not just a market reaction. It was, as many now believe, a decision. Somewhere between the promise and the reality, the ground began to shift. What had looked like a clear path toward lower interest rates suddenly turned into a much harder problem. Inflation, which had been trending down for months, came roaring back. And once that happened, the entire plan the Fed had been signaling to the world could no longer hold together. This is where most explanations stop. They say inflation went up, so rate cuts were no longer possible, so gold and silver fell. That much is true. But it only tells part of the story, because the real question is not why gold and silver fell. The real question is why the Fed appeared almost comfortable letting it happen. And to understand that, one has to look beyond interest rates and into something much bigger: timing. The timing here matters more than people realize. Midterm elections were approaching. And in politics, few things matter more than how people feel about their money in the months leading up to a vote. Nobody wins an election while voters watch their grocery bills rise and their savings lose value. The optics of inflation are almost more important than inflation itself. People do not read economic reports. They read price tags. They notice when a cart of groceries costs more than it did the year before. And when that happens, again and again, it becomes political. This created enormous pressure on the people in charge. If inflation numbers stayed high heading into an election, it would become a major liability. So a strategy took shape, one built not around fixing inflation itself, but around managing how inflation appeared. And this is where the dollar enters the picture. A strong dollar makes imported goods cheaper. Cheaper imports help pull inflation numbers down, at least on paper. It does not fix the underlying problem, but it changes the number that appears on the evening news. And that number is what most people vote on. So the dollar needed to look strong. And when the dollar strengthens, gold typically moves in the opposite direction. This is simple economics, not conspiracy. But it does raise an important question. If a strong dollar was the goal, and a weaker gold price was the natural result of that goal, then gold's decline was not just a side effect. It was, in many ways, a convenient outcome for those trying to control the story heading into an election season. None of this required anyone to manipulate a market in the dramatic way people often imagine. It did not need a secret meeting or a hidden order. It simply needed policy choices that favored a strong dollar, made at a moment when a weaker gold price served a useful political purpose. Sometimes the most powerful outcomes are not the result of a single dramatic action, but the natural result of many smaller decisions pointing in the same direction. Still, this alone does not fully explain the scale of what happened. A political motive can explain why the Fed would not fight to protect gold's rise, but it does not explain the full force behind the decline that followed. To understand that, one has to look past politics and into something far more serious, something structural, something that touches the very foundation of how the United States government continues to function year after year. Because behind every headline about interest rates and inflation, there's a much older, much larger story quietly running underneath it. A story about debt, about how much the United States owes, and more importantly, about who is willing to keep lending it money. This is where the story stops being about elections and starts becoming about survival. Because a government that cannot convince the world to keep buying its debt is a government in serious trouble. And as it turns out, gold and silver were standing directly in the way of that survival strategy. What began as a simple shift in interest rate expectations was starting to reveal something much deeper, a quiet, ongoing battle between two forms of money. One that can be printed without limit, and one that cannot be printed at all. To truly understand why gold and silver were pushed down, one must step away from interest rates and elections for a moment and look at something far less discussed, yet far more powerful. That something is debt. Not personal debt, not company debt, but the debt of an entire nation, one so large that it shapes decisions most people never see. The United States spends more money than it earns. Every single year, the gap between what comes in and what goes out grows wider. This gap has a name, the deficit, and it does not simply disappear. It has to be covered somehow, and the only way to cover it is by borrowing. Year after year, the government sells debt to investors, other countries, and institutions around the world, asking them to lend money in exchange for a promise of repayment with interest. For a long time, this system worked smoothly. There were always enough buyers willing to lend. But something has been changing quietly over the past several years. Fewer buyers want to hold this debt the way they once did. Central banks around the world have been stepping back. Instead of purchasing more government debt, many of them have been doing something very different. They have been buying gold. This shift may seem small on the surface, but its effects run deep. Every time a central bank chooses gold over government debt, it removes one more buyer from a market that depends on constant demand to function. And when demand falls, the government must offer higher interest rates to attract new lenders. Higher interest rates might sound like a technical detail, but the consequences are enormous. The United States already owes an amount so large that it is difficult to fully picture. And a significant portion of the money it borrows each year does not go toward hospitals, roads, or schools. It goes simply toward paying interest on debt that already exists. This creates a cycle that becomes harder to escape the longer it continues. Borrow to cover the deficit. Pay interest on that borrowing. Borrow again to cover both the deficit and the interest. Each year, the obligation grows heavier. And if interest rates rise even further, the entire structure becomes even more difficult to sustain. This is not a future risk. It is already happening quietly in the background of every economic headline. Now, consider gold's place inside this picture. When gold rises quickly and dramatically, it sends a signal to the world. It suggests that trust in paper money and in the institutions that manage it may be weakening. And when central banks see that signal, some of them respond by buying more gold themselves, further reducing their appetite for government debt. This creates a loop that works directly against the interests of a government that depends on constant borrowing to survive. Seen from this angle, a rising gold price is not simply a market trend. It is a quiet warning sign, one that threatens to make an already difficult borrowing situation even worse. If enough buyers decide gold is safer than government debt, the cost of borrowing could rise sharply, and the entire financial structure built on constant borrowing could come under serious strain. This is where the picture becomes clear. A weaker gold price does more than support a political narrative around inflation. It also helps preserve confidence in government debt at a moment when that confidence is already fragile. When gold falls, it can make holding government debt appear more attractive by comparison, at least for a period of time. It buys space, it buys time, and when an entire financial system depends on being able to keep borrowing, buying time can matter more than almost anything else. None of this requires imagining hidden meetings or secret plans. It only requires understanding incentives. A government under pressure to keep borrowing has very real reasons to prefer a world where gold stays quiet and government debt stays attractive. And for a period of time, that is exactly the world that existed. There's one more piece to this story, and in many ways, it may be the most important one. It has nothing to do with elections and nothing to do with debt payments directly. It has to do with belief. Specifically, what happens when people stop believing the story a central bank is telling them. The Federal Reserve's entire approach to managing the economy depends on one simple thing: convincing the public that inflation is under control or will be soon. This belief matters more than most people realize. When people believe prices will stay stable, they act calmly. Workers do not demand large wage increases. Lenders do not demand much higher returns on loans. Businesses plan with confidence. The whole system moves smoothly because everyone assumes the numbers will behave the way they are told they will. But when that belief starts to weaken, everything becomes harder to manage. If workers suspect prices will keep rising, they push for higher wages to keep up. If lenders suspect the value of money will keep falling, they demand higher interest to compensate. These reactions on their own can push inflation even higher, creating the very problem everyone was trying to avoid in the first place. In this sense, belief is not just a side effect of economic policy. It is the foundation the whole system stands on. This is where gold becomes far more important than most people assume. Gold does not respond to press conferences or official statements. It responds to trust, or the absence of it. When people begin to doubt that a currency will hold its value, many of them turn to gold instead. It has done this for centuries, long before modern central banks existed. So when gold rises quickly and sharply, it is not simply a market movement. It can be read as a signal, a quiet sign that trust in the system may be slipping. For an institution whose entire strategy depends on public confidence, this kind of signal is uncomfortable. A rapidly rising gold price does not just reflect economic conditions. It can actively damage the very confidence the Fed depends on to keep the system stable. In that sense, keeping gold calm becomes almost as important as controlling inflation itself. Not because gold causes inflation, but because gold can expose whether people truly believe the official story or not. To understand how seriously this kind of challenge can be handled, it helps to look back several decades, to a very different moment in economic history. In the late 1970s, inflation in the United States had climbed to levels that felt almost impossible to control. A man named Paul Volcker took charge of the Federal Reserve at the time, and he responded with extreme force. Interest rates were pushed dramatically higher, to levels that shocked businesses and homeowners alike. It was painful. Unemployment rose sharply, and the backlash was intense, but it worked. Inflation was broken, and it stayed low for decades afterward. Today, many people look for a similar figure, someone who might repeat that same forceful solution. But the world Volcker operated in was very different from the one today. Back then, the government carried far less debt, which meant it could absorb the shock of very high interest rates without collapsing under the weight of its own borrowing costs. Today, the amount of debt is so much larger that raising rates aggressively would create a very different kind of crisis, one centered not on inflation, but on the government's own ability to keep paying what it owes.